Welcome to Section 1. Introduction, Understanding Stocks and Bonds. Investing can seem like a complex world of numbers and jargon, yet understanding the basics of stocks and bonds is crucial for anyone looking to secure their financial future. These two types of investments form the backbone of most investment portfolios and have distinct roles and benefits. In this essay, we will simplify these concepts using real-world examples to help you grasp how they can work for you. Stocks and bonds are fundamentally different ways of investing your money, and each comes with its own set of risks and rewards. While stocks offer a share in a company's ownership and the potential for high returns, bonds are generally safer, providing regular income through interest payments. Knowing how each works is the first step in building a diversified investment portfolio. Understanding these investment tools will not only help you make informed decisions but also empower you to manage your financial future more effectively. Let's dive into the details of stocks and bonds, explore some tangible examples, and discuss how to start investing in them. Moving on to Section 2. What are stocks? Stocks represent ownership in a company. When you buy a stock, you become a shareholder, which means you own a small part of that company. If the company does well, the value of your stock can increase, and you might receive dividends as a share of the profits. However, if the company performs poorly, the value of your stock could decrease. For example, if you bought shares in a tech company like Apple or Google, you would benefit financially if those companies reported strong earnings and growth. This could result from innovative products or successful marketing strategies. Conversely, any setbacks such as legal issues or market competition could hurt your investment. Stocks are typically considered a high-risk, high-reward investment. This is because their prices can be volatile, fluctuating significantly based on the company's performance and market conditions. Despite this, stocks have historically provided higher returns compared to other investment types, making them an attractive option for long-term growth. And now, Section 3. What are bonds? Bonds are essentially loans that you give to a corporation or government in exchange for regular interest payments over a fixed period, after which your initial investment is returned. They are considered safer than stocks because they offer predictable returns and are less affected by market fluctuations. For instance, if you purchase a U.S. Treasury bond, you are lending money to the federal government. In return, the government promises to pay you interest at regular intervals and return your initial investment, known as the principal, when the bond matures. This makes bonds an attractive option for those who need steady income or are more risk-averse. However, bonds also have their risks. For example, if interest rates rise, the value of bonds can decrease. Moreover, if you invest in corporate bonds from a company that later faces financial difficulties, you risk losing your investment. Despite these risks, bonds can be a cornerstone for a conservative investment strategy, particularly for those closer to retirement. Consider the case of an investor who bought stocks in Amazon early in its growth phase. This investor would have seen significant returns on their investment as the company expanded its operations globally and diversified into various sectors. This example shows how stocks can provide substantial growth in wealth over time. On the other hand, consider a retiree who invests in municipal bonds issued by their local government. These bonds might pay lower interest rates compared to corporate bonds, but offer tax-free interest income, making them a practical choice for someone in a higher tax bracket looking for stable, tax-efficient returns. Both examples illustrate the different roles stocks and bonds can play in an investment portfolio. While stocks offer growth, bonds provide stability and income. Understanding these roles can help investors balance their portfolios according to their financial goals and risk tolerance. If you're new to investing, start by defining your financial goals. Are you saving for retirement, a house, or perhaps your children's education? Your goals will determine how much risk you can afford to take, which in turn should guide whether you invest more heavily in stocks or bonds. Next, consider starting with mutual funds or exchange-traded funds, ETFs, that invest in a mix of stocks and bonds. These funds offer diversification, which can help manage risk. Additionally, they are managed by professionals who can navigate the complexities of the stock and bond markets on your behalf. Finally, educate yourself continuously. The world of investing is dynamic, and staying informed about market trends, economic indicators, and financial planning strategies can help you make better investment decisions. Consider seeking advice from financial advisors or using investment apps that provide educational resources and tools. Investing in stocks and bonds is a powerful way to build wealth and achieve financial security. By understanding the fundamental differences and roles of these investment types, you can tailor your investment strategy to meet your personal financial goals. Remember, the key to successful investing is not just choosing the right assets, but also managing risks wisely and staying informed. As you embark on your investment journey, start small, diversify your investments, and always keep your financial goals in focus. With patience and persistence, investing in stocks and bonds can be a rewarding endeavor that contributes significantly to your financial well-being.